All right. So I decided to go live again because the last time I went live, you couldn't see me, and I wasn't really sure why. Let's see. I don't see anybody in here now. It doesn't look like we have anybody. I'm trying to figure out why that occurred so that it doesn't happen again. I'm not exactly sure. Uh, I'm not exactly sure why the screen went out. In any case, let's just go ahead and move forward here. So, what we want to talk about today are the players. What we were just talking about 30 minutes ago is how your emotions are used against you and for what reason they're used against you. So, let's just talk about how your emotions are used against you as an investor, as somebody who trades, as somebody who's in the market. So there are two major kind of roles to be played here. There's the person that is evoking, or the group that is evoking this emotional response. And then there is the group that is being emotionally targeted, right? Now, as we discussed 30 minutes ago, the reason you use emotions is the same reason you use emotion in anything. If I want to get someone to do something, if I am trying to sell you something, if I want to negotiate a price with you, what I want to do is I want to get you emotionally involved in the buy or the sell, right? So the same way you go to buy a car, if you start running down that it's a, I don't even know that much to be honest with you, but it's a V6, it has this much torque and it has this much lift, and it goes 0 to 60 in this. That's all well and good and logical and factual, and you're accurate. Nobody's denying that that's not accurate. But I'll tell you right now, you're not going to sell a ton of cars talking like that. The way you sell a lot of cars is you make the car look very pretty. You wax it, you wash it. They come in, they smell the leather, they smell the new fabric. It has that new car smell. What that's creating is an emotional attachment. That's creating an emotional bond to that car, so that effectively what's going on there is you now value the car and how it makes you feel more than you value your money. So when you go to sit down at that negotiation table, you are not sitting there saying to yourself or saying, that's too much, or I don't want that price off. I mean, it's the same reason that your parents, if they took you to buy your first car, explain to you, stay calm. Don't show them that you're excited. It's okay to be excited, but you have to stay calm. They told you that because all of your movements, everything that you did, if you leaned forward as he was talking, if you sat back, and you had your arms crossed, if your eyes went up, if you were just kind of slouched over, if you got yourself open, all of these things were indicators to that person on how excited you were about that vehicle. And that's the last thing you want to do when someone wants to get the most money out of you for the purchase of that product. So I think we can understand there how emotions are used and how they're read. Now, in a face-to-face meeting, reading emotions can be the fluctuations of the voice. It can be body language. It can be a lot of things. When it comes to the market, there's really only one visual representation of the stock market, bond market, currency market, commodities market. There's really only one visual aid, and people have them up all the time, and they put a lot of stuff on it to make it look very technical, and that's charts. And the reason that people use charts so much, you'll hear a lot of people say, well, if you're using a chart, that's technical analysis. Okay, I'm not telling you you're wrong. It is technical analysis, but it also tells the fundamental story. A chart is nothing more than, if you were to compare it, it's a book. If you speak English, it's a book written in English. Those words meant nothing to you when you were 4 years old. Those letters meant nothing to you. You had no idea what that book said, right? You had no idea if Charles Dickens was a good author, because it looked like gobbledygook to you. It was just a bunch of weird, odd shaped marks on paper. But somehow your parents read it to you and you were shocked, because to you, it was just brrr. That's what charts are to most people. And in fact, most people that are telling you they're talking about technicals with you, with moving averages and support and resistance and all this, the truth is they still don't know how to read the language. They don't know how to read the book. So if we talk about a chart, just understand the reason that you're talking about a chart, the reason you're discussing that is because that's the story of what's going on in the market. And within that story is who is trying to manipulate whom emotionally to get them to either buy or sell whatever it is they want them to buy or sell. Does that make sense to everybody? I'm going to throw up a quick Q&A. I know there's only a couple people in here, but I'm going to go anyway. Is there any questions? Does anybody want to ask me any questions in the chat there? And let me know if they just let me know if you understood. If you understood what I'm talking about, let me know if you have any questions about what I'm talking about when it comes to that buy and sell and that the use of emotion to make that happen. Any questions? I know there is only a couple of you here. No, is the I don't even, I hope the chat is available. It looks to me as though it is. Um no? No questions there? All right. Well, let's just move on then. So we know how emotions are used and we know why they're used, right? So we understand how they're used, we know why they're used. So let's talk about who is the group that is having their emotions used against them and who is the group that is causing this emotional response. Now, I want to say this before we get started, and that is that just because there's an emotional response does not necessarily mean that that is the intention of the person causing the emotional response. Okay. Sometimes one, when one person does something, an equal and opposite response is necessary. It's the old adage, right? What goes up, what must come down. Any action has an equal and opposite reaction. So I want you to think along those lines and understand that a lot of what happens to us personally and emotionally is a lack of understanding. Traditionally, our emotional response to certain stimuli is typically because of a lack of information, because we don't know any better. We don't understand what's going on, and therefore it causes a lot of anxiety. It's just like if you're driving down the road and your car peters out and and it stops. That's a very anxiety ridden situation if you don't understand motors and what's just occurred. Because for you, that car could be dead for life. Or it could just be something simple, but you don't know because you're not a mechanic and you don't deal in that world, right? So a lack of understanding usually causes an emotional response. So remember that as we go through this conversation. So who creates an emotional response, and then who is the responder, who is the person that's having their emotions, or the group of people that are having their emotions sort of toyed with? Well, that does vary, but let's speak in a very general sense right now and say that you have big banks and brokerage firms on one side, and then you have individual investors on another side. Okay. For now, let's just leave it at that. So, big banks and brokerage firms use trading desks, which has one goal. A trading desk has one goal. That's to buy stocks low and sell stocks high. And the goal of an individual investor is to buy stocks low and sell stocks high. So you both have the same goal. So in some ways, this is a negotiation, right? And it's a negotiation. You're negotiating with someone that has more control than you do because they have more money than you do. This is their whole life. This is how they make their living. And there are natural ebbs and flows of the market. So if you can learn to understand when and where those ebbs and flows are occurring, what will come from that is you will stop being a victim of your own emotional response to stimuli. Now, sometimes that emotional response is greed. Let's just use it. Let's just say it like it is. What is the fear of missing out? It is greed. That's what it is. You're afraid that you're not going to make money when others are. And so you get greedy and you go in with the knowledge that that price looks high. I mean, it's already run up 50%, but you think maybe it'll go another 25. That's fear of missing out. That's greed. That's one emotion that plays a very large role in your life as an investor. Another emotion, the other very strong emotion, if we're just going to polarized emotion, is fear. So when the market's dropping and it's fallen 20%, and you have no idea if a market's going to potentially fall 50%, what do? You get out. Because why? You got scared. It's down 20%. You have no idea how far down it can go. So what you do is you get out of the way. Is that a good or a bad thing? Well, it depends. Well, it depends on what? It depends on how far that market is going to fall. And you say to yourself, well, there's no way to know that. And I say to you that yes, there is. So let's start with these two players. And I'm going to try to keep this in under 15 minutes. So there's only about 4 minutes left. But if you have a trading desk on the institutional side, they want to buy low and sell high. Well, they're buying a lot bigger of a position than, say, someone at Robinhood, right? Or someone at E-Trade or someone at Schwab or wherever they're trading through. It doesn't matter where they're trading through. Obviously, a trading desk at a major institution is buying a lot more stock. So while they're buying this stock, ABC, what happens is they're going to continue buying it, right? They're going to scale into their position, buy a little more, buy a little more, buy a little more. What they're doing is they're creating a support level for that stock. It's a base, and that base travels upwards every time they make a purchase. Every time they make a purchase. Now, as that stock increases in value, let's just say 30%, it's up 30%. I'm just using an arbitrary number. Now the trading desk says, well, we want to sell some of this position so that we can buy it back later. Why? As you know, there's an ebb and flow to the markets. Once every 3 years, we have a bear market. Now, some of that bear market is caused because if you're a trading desk and you can never sell and you're only buying, you're going to run out of money. You're going to run out of stock you have to buy and sell. So what happens? You created this support level. The trading desk created a support level all the way up, right? Every $5, let's say. And then what happens is they want to sell it. Now, what's the best way, do you think, to get somebody really excited about buying a position that you want to sell? Well, there's a couple things you can do, but let's talk about the first thing you could do. And the first thing you could do is make it show up in the media. And how do you do that? Put out a few press releases saying ABC stocks up 30%. Maybe you move price another 5-6%. You put a little money into moving price up. Then the fear of missing out hits the individual investor side and they start buying it. But you're selling it. So what you're slowly doing is you're removing those previous support levels. So as you were buying it, you were creating these support levels in price. But now you're removing those support levels in price. And as retail picks that stock up, ABC, from the trading desk, well, the trading desk isn't purchasing anymore, are they? They're selling. So there's no support, and there's not going to be any support created because trading desks aren't buying any more stock. So prices just begin to fall. Right? Now, as those prices begin to fall, the same emotions will come back. Fear will set in to the retail side, and then trading desks will begin to pick it back up, and prices will begin to rise. Support levels will begin to start, and round we go. Now, what I'm here to tell you is there's one way, or there's several ways, but one of the biggest ways and easiest ways to know when this is happening and to know to what degree it's happening is if you're an institution and you buy a lot more of a stock than an individual investor, then you do a lot more trading, right? Maybe you're buying 100,000 shares at a time, which is one block. You're buying one block at a time. Whereas the individual investor, maybe he's buying 1,000, maybe he's buying 50. Well, that shows up. You can see that when you're reading the story of the stock market. How do we read the story of the stock market? How do we read what's going on right now? Well, we look at the book. What's the book? The book is the chart. And on that chart, big things show up. You can identify areas of inflection. And once you identify those areas of inflection, and by inflection, I mean you can see when larger institutions are selling. Now, you may not know to what degree, but you can see the big selling occurring. And guess what you do when that happens? You either start to level out, get your position neutral, so you sell as well. You can apply a short. There's options, there's futures, there's several strategies to get yourself market neutral. So as they remove those support levels and price falls, you're not affected. And then you can buy back when they buy back. Now, for those guys out there that day trade that tell you that that's the wrong way to do it, there's several advantages to doing it this way. And one of them is a tax advantage. You see, if you're buying and selling all the time, and it doesn't matter if you make $1 million this year and you're trading every single day, you're going to be in a higher tax bracket. You're going to pay about 50% in taxes. So you made 500,000 in gains, which guess what? Means that if I made 600,000 in gains and it's charged at, a long-term capital rate, which is 15 to 20%, I made more money than you. Yeah, you traded $1 million on, and you made $1 million trading, and I made 600,000 in trading. But guess what? My taxable income is nowhere near yours, and I actually made more money than you did. So there's advantages to doing it this way. Now, what I'm going to put up now is just I have my courses here, and what I'm starting right now is my VIP mentorship course, and it's a financial EQ. So emotional intelligence, understanding how to identify these areas where your emotions are being manipulated a bit, and the strategies on how to get neutral. It's a 6-week course. We do 1 hour live, which usually turns into about an hour and a half. It is recorded if you're unable to attend. I do 1 hour of Q&A, which sometimes honestly turns into 2 hours of Q&A a week. That is also recorded if you're not able to attend. And you always have my email to reach out to me directly during this course. And you have a chat. We have a community for this particular mentorship course. And you can go in there and you talk to each other as well. That course until Sunday is 50% off for Mother's Day. I'm having a discount of 50% off through Mother's Day on Sunday. So 6-week course for $500. You can't beat the price. I'm making it that price because I'm getting these courses off the ground, and I'm making myself better known, and I'm offering you a price at which you can't pass up. What that can save you if you're actually investing will blow your mind. I mean, think about it. If you avoid one bear market of 50% and maybe only a 10% loss, and it doesn't matter how much you have, even if you have $20,000. I just saved you $10,000 for a $500 course. Now you start moving into more serious money, and you can see what this course can do for you. I'm going to leave that up there for now. I hope everyone enjoyed this. At least you could see me in this one. In the last live, you couldn't even see me. But I appreciate everyone who showed up. It looks like there's only a couple people here, but that's fine. I hope you did enjoy it. I didn't get any questions, but if you do have any questions, feel free to email me. It's dmiller@prometheaninvesting.com. Website is right there, www.prometheaninvesting.com. You can reach out to me there as well. I have a free newsletter if you're interested. But until next time, I'm probably going to go live quite a bit now. I'll see you later, and thanks for listening. I hope you enjoyed it.